The notification hits your phone at 4:32 a.m. on a Friday morning. Your direct deposit has officially cleared. It is the exact number you spent 80 hours of your life over the last 2 weeks to earn. But as you sit on the edge of the bed in the dark, looking at the glowing screen, there is no sense of achievement. There is no relief. Because before your eyes even fully adjust to the light, you already know the truth. That money does not belong to you. It already belongs to the mortgage servicing company. It belongs to the auto lender, the health insurance provider, the local utility grid, and the daycare facility. By 8 light a.m., before you have even poured a second cup of coffee, the digital balances will shift, the automated withdrawals will trigger, and the math of your life will resolve itself back down to a familiar, suffocating baseline. For millions of Americans, the modern paycheck is no longer a tool for building a future. It is simply a temporary holding account for institutional bills. Consider a household like Mark and Sarah's. They live in a quiet subdivision just outside of a growing mid-sized city. They did everything the traditional script demanded. They went to college, secured stable corporate jobs, and brought home a combined income that puts them safely inside the statistical middle class. On paper, they are succeeding, but the reality inside their kitchen tells a completely different story. Every professional milestone they achieve, every marginal raise they negotiate, is instantly absorbed by a category of expenses they never explicitly chose to expand. They are trapped on a beautifully corporate, highly exhausting treadmill, where they must run faster just to stay in the exact same place. The traditional economic headlines will tell you that wages are up, unemployment is low, and consumer spending is resilient. But the kitchen table says something else entirely. It asks a much simpler, more haunting question. Why does a bigger paycheck buy a smaller life? In this documentary, we are not going to talk about budgeting hacks, cutting out your morning latte, or downloading another generic savings app. Instead, we are going to perform a forensic autopsy on the modern American household budget. We will expose the hidden mechanism that shapes your money before you ever get a choice to spend it. Because the most dangerous reality facing families today is not what they are choosing to buy. It is what they are forced to pay just to exist. By 7:15 a.m. on Friday morning, the invisible extraction begins. Sarah sits at the kitchen island with a travel mug of coffee, watching the digital dashboard of their primary checking account. She isn't looking at a luxury shopping cart or booking a vacation. She is watching a series of automated line items clear. First, the mortgage payment, the single largest anchor in their budget, moves out. Next, the auto insurance premium, which quietly jumped 15% last month without warning. Then, the bi-weekly invoice for their youngest child's daycare facility clears, a staggering cost that feels like a second mortgage entirely. Within less than 3 hours of arriving, nearly 60% of the direct deposit is gone. But the strangest part isn't that the money leaves. It's how quickly it happens without a single luxury being purchased. Mark and Sarah aren't living an extravagant lifestyle. They don't wear designer clothes. They rarely eat at high-end restaurants, and their vehicles are sensible mid-sized crossovers designed for utility, not status. Yet, their checking account looks like a bucket with a dozen tiny holes drilled into the bottom. Every time wealth tries to pool, it drains away through a massive network of non-negotiable plumbing. The pressure follows them into the weekend. On Saturday afternoon, Mark stands at the grocery store checkout line, watching the digital register climb past $250. Down at the cart. It contains basic proteins, fresh produce, milk, cereal, and a few household cleaners. A few years ago, this exact haul would have cost half as much. And once this pressure reaches the checkout line, the math shifts from annoying to deeply unsettling. It creates a bizarre psychological dissonance. You look at your W-2 at the end of the year and see a number that your parents would have considered a massive success. You are earning more money than you ever have in your life. But when you look at the physical reality of your refrigerator, your garage, and your savings account, you feel remarkably poor. This is the visible crisis of the modern American middle class. It is the overwhelming sensation that you are doing everything right, following every traditional rule of financial discipline. But the waterline is still steadily creeping up toward your chin. You aren't drowning because you are reckless. You are drowning because the basic baseline of survival has become incredibly expensive. What Mark and Sarah are realizing, and what millions of families are discovering at the exact same moment, is that the fight isn't over discretionary spending anymore. The fight is over the fixed costs that are locked in long before they ever wake up on a Monday morning. To understand why Mark and Sarah feel this way, we have to look past the surface noise of daily inflation. We have to strip away the common narrative about lifestyle inflation or poor spending habits, and perform a deeper diagnostic on the structural mechanics of the modern American economy. Underneath the daily stress of the checkout line lies a concept economists call the fixed cost floor. A generation ago, the average middle-class household budget was built with a relatively low floor and a high ceiling. The non-negotiable costs, the structural expenses required just to hold a job, maintain a home, and stay healthy, consumed roughly half of a family's take-home pay. The remaining 50% was discretionary margin. It was breathing room. It was money that could be saved for retirement, invested, spent on family vacations, or easily pulled back if a parent lost a job or an emergency hit. But over the last few decades, that structural floor has risen dramatically. The real story starts with a line most families never look at. While average wages slowly ticked upward on paper, the core components of basic American stability, housing, healthcare, childcare, and automotive infrastructure skyrocketed at double or triple the rate of wage growth. Today, for a dual-income family like Mark and Sarah's, the fixed cost floor doesn't sit at 50%. It routinely consumes 70 to 80% of their net income before they ever buy a single gallon of milk or a pair of shoes. This is the birth of the no-margin household. When your fixed cost floor is that high, the traditional rules of budgeting break down. If Mark and Sarah cut every subscription service, stop drinking coffee entirely, and strictly buy generic grocery brands, they only adjust their remaining cash by a few percentage points. They cannot easily downsize a mortgage in a high-interest rate market. They cannot opt out of corporate health insurance premiums, and they cannot leave their young children unattended while they work an 8-hour shift. What looks like a series of personal choices is actually a structural mandate. Modern American life has effectively transitioned into a high-cost subscription model where the basic package required for employment and baseline safety demands a massive, upfront financial buy-in. You are locked into a framework of institutional bills long before you ever get a say in how your wealth is allocated. And this leaves the modern family trapped in an incredibly fragile, high-stakes game. When there is zero margin built into the structural floor, a single unexpected variable doesn't just disrupt the monthly plan. It threatens to derail the entire foundation. If you ask Mark and Sarah whether they consider themselves struggling, they will hesitate. They have the corporate titles, the suburban zip code, and the college degrees. But if you step away from their kitchen counter and look at the broader macroeconomic data across the United States, their quiet financial panic isn't an anomaly. It is the exact statistical baseline for the modern middle class. For years, living paycheck to paycheck was a phrase reserved for entry-level workers or low-income brackets. But the numbers reveal a paradox that traditional economic headlines consistently overlook. Recent data from consumer surveys conducted by organizations like Bankrate and Lending Club indicate that a staggering majority of American adults, including a significant percentage of those earning six-figure salaries, now report living paycheck to paycheck with virtually no money left over at the end of the month. The reality is that wage increases have been running a race they were mathematically locked to lose. According to data categories tracked by the Bureau of Labor Statistics, BLS, Consumer Expenditure Survey, the cost of non-negotiable line items, has structurally decoupled from typical median family earnings over the last several decades. When you look at the percentage of income swallowed by housing costs, domestic energy, and basic medical premiums, the modern family is operating at a massive structural deficit compared to previous generations. The real disruption starts when an ordinary household encounters an unchoreographed event. When 75% of your income is spoken for before the month begins, your entire life relies on perfect execution. You need your car transmission to never fail. You need your children to never get sick. You need your corporate employer to never undergo a restructuring phase. But life is rarely perfect. Federal Reserve studies examining household financial health consistently point to a troubling reality. A massive segment of the American population lacks the liquid savings to cover a sudden $1,000 emergency expense without using debt or borrowing from family. When that emergency inevitably arrives, it forces households to bridge the gap with credit cards, compounding the fixed cost floor with high-interest monthly minimum payments. The numbers tell us something that personal finance gurus frequently ignore. The modern middle-class family isn't mismanaging their money. They are managing a mathematically unforgiving landscape where the margin for human error has been completely erased. And when that realization settles in, the consequence stops being strictly financial. It turns into something deeply psychological. When you live inside a budget with no margin, the damage eventually migrates from your bank account directly into your psychology. And this is where the story stops being about money. For families like Mark and Sarah, the constant erosion of their paycheck doesn't just change what they can afford to buy. It fundamentally alters how they view the future. When every waking hour is consumed by managing the high-cost subscription model of modern American survival, the brain shifts into a permanent state of low-grade fight or flight. Psychologists call this survival mode. In this state, the horizon of your life shrinks. A household with no margin does not make long-term plans. It makes it to Friday. You stop thinking about saving for a down payment on a better home. You stop calculating retirement projections. And you stop dreaming about career transitions. Instead, your mental bandwidth is entirely monopolized by the immediate, crushing present. Will the utility bill clear before the paycheck hits? Can the brake pads last another 3 months? This continuous pressure breeds a deep sense of learned helplessness. But the most uncomfortable turn is how this changes consumer behavior. When traditional milestones like homeownership or a secure retirement feel mathematically impossible, many people don't save more. They actually tap out. They stop denying themselves the small, immediate comforts of daily life. This explains the modern paradox of the American consumer. Why people who claim they are completely broke are still buying premium coffee, dining at casual restaurants, or purchasing concert tickets. This is not laziness. It is exhaustion after the math stopped working. People do not give up because they lack discipline. They give up when effort no longer connects to reward. When working a 40-hour corporate week no longer guarantees basic financial stability, the psychological contract of the American dream breaks down. The small luxury ceases to be a reckless financial choice. It becomes a form of emotional self-medication. A tiny, affordable rebellion against a life that has become entirely locked down by fixed costs. But while this survival psychology is entirely understandable, it also fuels a fierce societal debate, because to an outside observer, the line between a broken system and bad personal choices is incredibly blurred. When you zoom out and look at the sheer velocity at which money leaves a modern household, it inevitably ignites a fierce societal debate. But not everyone agrees with this explanation. Walk into any personal finance forum, talk to an older generation of savers, or listen to traditional economic commentators, and you will hear a completely different diagnosis of the exact same problem. They will point out that while the cost of housing and healthcare has undeniably risen, the modern American consumer has also completely rewritten the definition of a basic necessity. This is where the argument gets uncomfortable. The counter-argument is straightforward, and it deserves to be taken seriously. Critics argue that families aren't strictly trapped by an unyielding economic design. Rather, they are trapped by lifestyle inflation and a refusal to sacrifice. They point to the ubiquity of $70,000 pickup trucks in suburban driveways, financed on 8-year loans. They highlight the billions spent annually on third-party food delivery apps, high-end streaming bundles, luxury gym memberships, and financing options that allow consumers to break ordinary retail purchases into monthly installments. From this perspective, the math hasn't broken. Discipline has. But this is where the debate requires a deeper level of balance. To understand the true reality of modern American life, you have to realize that both sides of this argument are holding a piece of the truth. Personal choices absolutely matter. No economy can save a household that uses high-interest credit cards to fund a lifestyle it cannot afford, or one that purchases a home at the absolute peak of their borrowing capacity, without leaving room for a rainy day. Financial discipline remains a critical baseline. However, looking strictly at consumer behavior completely ignores the changing structural weight of the baseline itself. Even if a modern household exercises flawless financial discipline, even if they drive a 10-year-old car, cook every single meal at home, and completely eliminate discretionary entertainment, the cost of their non-negotiable floor remains historically unprecedented. You can budget away a streaming subscription or a premium coffee, but you cannot budget away a childcare bill that rivals state university tuition, or a home insurance premium that doubles in a single year because of shifting environmental risks. The real friction of modern America isn't just that people are making bad choices. It's that the penalty for a single bad choice, or even a single piece of bad luck, has become devastatingly high. The system has evolved such that the margin between perfect safety and immediate precarity is razor-thin, turning everyday life into a high-wire act where consumers are blamed for losing their balance, even when the wire itself is shaking. If the structural math of American life has fundamentally shifted, the solution isn't to look at your bank statement with a sense of lingering shame. The solution is to look at it with absolute, cold-blooded clarity. To break out of the paycheck trap, we have to stop using an outdated framework to solve a modern survival problem. Traditional financial advice tells you to track every single penny, look for coupon hacks, and deny yourself basic daily comforts. But when your fixed cost floor already consumes 80% of your take-home pay, you aren't facing a discipline deficit. You are facing a structural visibility problem. But the most important step forward doesn't involve downloading another budgeting app. It requires a radical recategorization of your money, based on how much control you actually possess over it. To find traction when you feel completely trapped, you have to divide your monthly exit lines into 3 distinct, unsentimental columns. Rigid costs required just to stay housed, healthy, and legally employed. The mortgage, the health premium, the non-negotiable commuter infrastructure. The systemic friction. These are the ongoing bills that keep the household running. Utilities, streaming packages, credit card minimums, and automated memberships. The emotional relief margin. These are the convenience purchases, the takeout dinners, the premium coffees, and the small retail moments. And this is where most household financial plans completely fall apart. When families feel the squeeze, they immediately launch an aggressive attack on the third column, the emotional relief margin. They strip away the tiny elements of comfort that make a 60-hour workweek tolerable, trying to heal a massive structural deficit with small, painful sacrifices. The math doesn't add up, psychological burnout sets in, and they quickly give up. The practical map through this landscape requires you to stop blaming yourself for the height of your structural floor and start aggressively targeting the systemic friction instead. You have to take responsibility for what can realistically be optimized within the fixed pipeline. Can you spend an afternoon shopping your home and auto insurance through an independent broker to to shake loose $70 a month? Can you perform a forensic audit on your bank statement to cancel the phantom subscriptions that drain $90 without your daily permission? Can you renegotiate fixed utility rates or look at a strict debt avalanche strategy to slowly chip away at monthly minimum payments? More than anything, this framework requires you to decouple your self-worth from the economic environment. You must stop apologizing for the reality that a middle-class life requires a massive, upfront financial buy-in today. But you must also refuse to let that fixed pipeline run on absolute autopilot. By auditing the structural plumbing rather than obsessing over the variable drops, you begin to claw back the one asset the modern economy consistently tries to extract from you: your sense of agency. Next Friday morning, the notification on your phone will arrive at exactly the same time. The numbers on the screen will not have magically changed. The automated withdrawals will still trigger. The institutional bills will still claim their share, and the fixed cost floor will remain just as high as it was last week. But as you look at that digital balance in the early morning light, something else can change. The weight of personal shame can begin to lift. When you understand the hidden mechanics of the modern American economy, you realize that the anxiety you feel at the kitchen table is not a reflection of your character. It is the logical consequence of a structural design where the baseline of survival has become incredibly expensive. You are not drowning because you lack discipline. You are navigating a landscape that has systematically squeezed out the margin for human error. Mark and Sarah still sit at their kitchen island, matching invoices against their direct deposits. The math is still hard, and the pressure is still real. But they are no longer fighting in the dark. They are identifying the hidden friction, optimizing the pipelines they can control, and fiercely protecting the small pockets of breathing room that keep their family grounded. The paycheck may be spoken for before it even arrives, but it no longer has the power to define your success as a human being. Hard work in America might not buy the same predictable stability it did 40 years ago, but clear-eyed clarity can still buy you a path forward. Before you close this video and step back into the rhythm of your own week, look closely at the shape of your monthly math. Stop apologizing for a structural floor you didn't build. Take radical responsibility for the friction you can control, and remember that financial survival mode is a season to be navigated, not a permanent verdict on your life. We want to build a real map of what everyday life actually looks like across the country right now. If you are willing to share your story below, tell us, do you think the paycheck-to-paycheck struggle is primarily a personal discipline problem? Or has the structural math of American life fundamentally changed? Which bill is putting the most pressure on your kitchen table this month? Is it rent, childcare, insurance, or groceries? If this deep dive gave you a clearer framework to understand your own daily expenses without the burden of personal blame, consider hitting the like button and subscribing to the channel. It helps ensure these data-driven, independent investigations can continue reaching the families who need to hear them most.